Wednesday. We have made it halfway through the week. Welcome to the CommStock Channel. My name is Brianne Hendrickson. Today I have Joe Camp with us. Welcome.
Hi, we're getting there.
We're getting there. And for me personally, it feels like a very long week, and we are only on Wednesday. I don't know about you.
Yeah, it's been a long week. Certainly with these markets trading mostly lower, it's been a dull type of trade, light volume, lack of fresh news. So it does make it seem like longer market sessions at least.
November 8th through the 13th, I will be traveling from Texas to southern Indiana. I would love to stop by and capture your farm story or how harvest went. Want more information or want to schedule a day? Send an email to report@commstock.com. How is the current lack of fresh input affecting the grain market? And why is that kind of favorable for the bearish spectators?
Yeah, that's what we see right now is a lack of fresh news really playing into the hands of those bearish hedge funds. We saw, up until late last week, some upside for the grains, for corn and soybeans in particular. We had a lot of conversation about possibly seeing the harvest lows behind us, and that could still be the case. We're up above where we bottomed out for corn about a month ago in September. For soybeans, it was on the October 12th crop report day, the morning of, where we put in our recent low, and we're still above that by a good clip. But late last week ran into some resistance, and that really brought the speculators in play. And so starting with that conversation about the speculative positioning, I worked up a chart here on where traders are positioned in the soybean market first. And it's notable because what we see at the very tail end of the graph, you've got this managed money position, I believe in blue, that's now fallen to net short. It's fallen below the zero line to represent that there are more shorts held by the hedge funds than longs. So a net short position in soybeans. But what's remarkable about that, unfortunately, is that it accounts for the first net short position held by managed money in over 3 years. I mean, as far as I can tell, this goes back to April of 2020, when was the last time that these money managers were net short the soybeans. They've been bullish since then until just here last week, flipping that position now a little bit net short. Now, whether or not it continues to go lower from here, we'll see. A lot of that will have to do with the charts, but we'll talk about that. First, I want to get back to these trader positions. We talk about the speculators and how they're now net short on soybeans. If we look at the corn positions, you see that blue measure of managed money positioning has been net short for some time. I think what's more notable about this corn chart here with trader positions is actually the red lines, which on corn you can't see. They're covered up by the blue lines, but that means they're really small. And if we compare them in particular to the size of the position, the red commercial traders, to where it was a year ago, I think it says something important about how this market is positioned. And so, again, in red, these are the commercial traders. These are going to be your elevators, your end users, your exporters, all of the above, mills. And they are going to be primarily hedging short in the market when they're purchasing this grain from the farmer, right? You buy it from the farmer, you sell it on the board to hedge your price risk before you trade it off later on the commercial end. Well, that's a very small net short position is the point here, and comparatively very small to where we were a year ago. And what that means to me is that the buyers, the commercial end users, have bought less corn, and this is similar on the soybean chart too, less corn and soybeans than they normally have at this point of the year. So it's, harvest, we got those crop progress numbers. We were more than 75% finished on soybeans. We're getting close to that on corn here this week, yet the end user hasn't bought a lot of it. The commercial crowd hasn't bought a lot of that. And so I think, anyway, looking forward, this could be a bullish point of the market that we're going to put this crop away. and now those end users are going to really have to bid for it to get it out of the farmer's hands.
Remember, we are still accepting your yield results, and don't forget to send in those pictures and videos as well. You can send them in at report@commstock.com. So what are the conditions under which funds are likely to start buying again in the grain market?
It starts with the charts, the technicals, I believe here. We know that when we're talking about hedge funds, managed money, we're talking about computer algorithms in a big way, a lot of money that's based on what the chart's telling them. And what we saw here last week, if we bring up the corn futures chart, December corn, it's really clear what happened on that rally. We ran up, we poked above the upper Bollinger Band. We talk about those often when we're looking at charts because they are a measure of volatility relative to the past, say, 20 days. There are a couple of standard deviations above and below the 20-day moving average, which you see there in the middle of the chart. But what happened was corn prices had run up to that top band, so it'd been a maybe relatively extra volatile move comparatively. But it also coincided, you can see that top late last week with the 100-day moving average, that blue line above the market. So that was a resistance level that, because we did not get past it and follow through with additional buying, those hedge funds that are net short that market are using it as a spot to be selling again. So they're trying to defend those bearish bets, and that is on the basis of this chart resistance that we're seeing. Now, we have fallen back below the middle of the range, that 20-day moving average, but we can see now that prices are back down to the lower Bollinger Band, maybe they're going to find support again. As long as they stay above that low from last month, then we could see continued a continued waning of selling interest, at least. But what it'll take for them to flip more bullish is that we actually get back above that $5 mark for the nearby futures, and that we could surpass eventually that 100-day moving average. Now, I think it's important to note what happened there on corn, because we see it play out in a similar way on soybeans. If we look at the soybean chart, we topped out here late last week exactly at the 100-day moving average, which was the top end of the range, that upper Bollinger Band. So those are areas where the speculators are stepping in and selling because we haven't proved those points of resistance broken yet. If we do get past those levels, I think we could see some follow through that would eventually change sentiment into something less bearish and more bullish. And that fits too with what we've talked about with trader positioning and the fact that recently that run up to $5 December futures to $13 November soybeans, it did buy some cash grain out there in the country, but it won't necessarily buy as much next time. Farmers have made some sales, and now we're getting to a point where this crop's going to be by and large put away, and there's going to be patience for higher prices. So that's the number one thing. The next thing would hopefully be that we see some better export potential.
So do you see any implications or any significance in any of this?
Yeah, well, one thing I see is that there are these competing factors. We talk about the technicals and how important they are, but also we can't lose sight of the fundamentals of it all. And that's where I bring up the export factor. So it could be that something shifts on the chart to get those computer algorithms in a more bullish mood, but it could be that we start to have more headlines that convince those discretionary hedge fund traders to want to be more bullish. And so we're watching exports for that because they make up the headlines, and we could get more of that. I could see that popping up here. Late last week, there were rumors of connections with China on wheat, which they have purchased more of from the U.S. lately, and even corn. And that's going to be a big deal if they finally step into the market for additional quantities of U.S. corn, because they have not had a lot of interest so far yet this year. Soybeans, we had a couple of cargoes sold on a daily flash sale announcement here this morning, but we're looking for bigger volumes, and particularly after this latest meeting of the trade delegations, Chinese trade delegation coming over, meeting with some U.S. farm and exporter representatives in Iowa and supposedly inking a deal to make purchases. This is a so-called sort of ceremonial deal, but at the same time, We know in the past these have sometimes led to some big purchases in the days or weeks after these meetings. So we'll watch out for that. Again, the flash sale system, it comes out anytime a grain export deal is made for more than 100,000 metric tons. There's going to be one of these flash sales triggered. So it's what I'm keeping an eye out for, something that along with these charts could potentially turn the speculators more bullish again.
Kind of wrapping up, talking about exports, in what scenario might these hedge funds consider buying again if export grain commodities start to pick up considerably?
Yeah, that's going to be on the basis of those headlines. If they start to see more of those stack up, it's starting with those daily flash sales, but it extends each week to the update that we have on Thursday morning regularly for the weekly totals. We need to see, as we show this chart for soybean exports year to date, you've got the current, it's behind a year ago, it's behind the 5-year average. If that starts to catch up, particularly to where we were last year, that's going to signal some more buying because, for one, exports are projected to be lower already this year. But if they start to improve, then we're wondering about the need for prices to be rationing our demand. Because right now, if we were to export as many soybeans as we did a year ago, we would have a negative carryout. And that's because the processing demand is so much higher here this year. It's because we're still relatively tight on the supply side. So that's one thing at the margin that can make us even more tight than we already are. If those hedge funds start to see that in terms of better numbers on the export front, I think that's going to be what it takes.
All right. Do you want to add anything else?
We'll just keep an eye on those outside markets too. We want to talk about what's going on with the charts, with the fundamentals of export demand and processing margins and all that. But sometimes it gets in the way if we have any outside market worry, like stock markets selling off, or if the dollar continues to rally along with bonds selling off. That could be a point of worry for the market. But overall, if we start to have some economic confidence restored here, we could see that dollar come down, and the opposite of it. We'd have more support that we could get back to thinking about the more bullish fundamentals of it all, and eventually a better looking set of charts.
Let's switch over to reports coming out this week and happening today. Wednesday, October 25th, the EIA stocks and cold storage comes out. Thursday, October 26th, export sales, the gross domestic product Q3, as well as the jobless claims report comes out. Wrapping up the week on Friday, October 27th, it is a big one to write down on the calendar. November grain options expire. Please make sure you contact your brokers before Friday to set up a plan. All right, thanks so much. That'll do it for this episode. Want more premium content? Subscribe to the CommStock Report, where you will receive 2 reports daily. Want more video content? We are on Facebook, YouTube, and now TikTok. So don't forget to like, follow, and subscribe.